Hey everyone, in this video we're going to continue on with the chapter 10 homework, and in this specific video we're going to be looking at the discussion questions, quick study exercises, and problem tabs here for chapter 10. Okay, so first thing I always like to do is just kind of take off the grid lines, give myself some extra space. Whoop, a little too much space there, yeah, kind of, I don't know about you, but I like just having a little free space here to think through the questions without too much clutter. Okay, so discussion question number 1 asks us to identify some non-financial factors that should be considered when making managerial decisions. So factors include things such as employee morale is a good one. We talked about rework or scrap, and so that's one area to kind of look at, because if there's a lot of tedious rework that needs to be done and taking things apart and putting back together, that can be kind of damaging to employee morale, and you don't want to lose your talented, employees, etc. Something we talked about when I was in my position at a banking financial institution was reputation risk and public image. And so doing something that could hurt the public image of the company and our reputation could lead to, reduced sales and boycotts and, all that kind of stuff. So we want to be careful about how we pursue from that perspective. Environmental impacts is another one. So that might not have a direct specific cost to us necessarily, or at least one that the company directly recognizes, but it can have obviously an impact on the environment, and then that sort of leading into reputation risk, public image risk, etc. So those are kind of sub factors, and those things, again, some other concepts that fall in that same bucket: social responsibility, political sensitivities. Let's see what else. Impact on, let's say, other / current customers. This is one we talked about with, taking on additional work. So a lot of it really comes down to these factors: employee morale, and reputation risk and public image. And then these are also, they're factors, but they kind of fall under, a big part of really reputation risk and public image. If we're doing something to impact these things, then that could have an effect on us, a detrimental effect to the company in terms of public image or reputation, etc. Okay, discussion question B says, why is it important to determine contribution margin per limited resource in a sales mix selection decision? Oh, there. Oh, that one's kind of misspelled too. Let me do a spell check here. There we go. Let's put our text box in. Okay, so why is it important to determine contribution margin? And let's see here. In a sales mix selection decision, it is important to first determine the contribution margin per a limited resource, as this helps know, this helps, how do I want to say this? It helps you understand the products with the highest contribution margin, highest to lowest, we'll say, basically ranking them, highest to lowest contribution margins, which we can then use to maximize those products with the highest CM, we'll just say, as constrained, or maximize demand, let's say that, maximize and meet, or to meet demand for the products. Let's say that. I think that makes sense. To meet demand for the products with the highest contribution margin. And once we meet that demand, if there's no more demand for a certain product, we can move on to a separate product, but we want to figure out where to start, basically. And we saw that, in the number of different problems we worked on there. So hopefully that makes sense. All right, I'm just going to copy and paste our text box down here. Delete that out. And what is a relevant cost? Identify two types of relevant costs. Relevant costs in terms of management decisions are costs that differ between two alternatives. Let's see, they are also called avoidable costs, in that if the decision is to do nothing, then those costs can be avoided, right? And two types of relevant costs are out-of-pocket costs and opportunity costs. So if you think about it, we talked about in class, and I think in the lecture a little bit about going to school or going to college, as being one of these instances where you're making a decision, a personal financial decision, basically. And you can kind of think of these two things as, the out-of-pocket costs of going to college is the amount that you're actually going to have to spend, and the opportunity cost is the amount of income that you could have been earning working full-time, if you're not working, or working two jobs instead of one, or whatever it might be. But the time that you're spending in class that you can't be doing other things that could potentially be earning you money, then could be considered an opportunity cost of going to school. Maybe that's even just kind of like free time, in a way. You could think of it personally that way. There's an opportunity cost to sitting in class. Hopefully you don't hate it too much. And the whole thing about going to school then is, you have these out-of-pocket costs and opportunity costs, but then hopefully the benefits outweigh those costs of future earnings, and, through earning an education and a degree and all those kind of things. So that's kind of the decisions. Sometimes we don't take the time to really think those things through in that clear of a way. Personally, I know when I was going to college, I didn't really think that much about my own personal life, I guess, from a perspective of costs and pros and cons and cost benefits and everything. But, that's kind of what we're doing in our own personal lives, is similar to what we'd be doing as managers of a business, trying to make good decisions, basically. So, yeah, kind of carries over there. Okay, why are sunk costs irrelevant in deciding whether to sell a product in its present condition or to make a new product? So sunk costs have already been spent and make no difference on whether to pursue the different avenues of either selling a product in its present condition or do additional processing. And because they've already been spent, they're gone, they're done. We've got our product where it is. So the only costs that are relevant for the decision are the additional costs incurred, I would say potentially incurred, in the different, or we would say in the alternative decision pathways. Hopefully that makes sense, right? Basically, you have the product one way or the other. Whatever you paid for it to get it to where it is really doesn't mean you're going to earn more profit one way or the other necessarily, because it just doesn't have a bearing on the next steps that you take. Those costs were relevant when you made the decision to purchase at that point, and choose that decision. But and now, when you're at the point where we need to continue to process or sell it, etc., those costs don't get to be included as a decision factor necessarily, because they're already gone, they're done, they're spent, right? What you need to decide is, should we incur additional costs to keep going down a certain pathway, or should we just cut our losses in a way and choose to sell as is, kind of a thing, for a discount, like we've talked about in some of those problems we've looked at. All right, what are out-of-pocket costs? Pretty easily said. Out-of-pocket costs are costs that will be paid depending on the decision, one way or the other. Are out-of-pocket costs recorded in the accounting records? These costs will be recorded in the accounting records once incurred, i.e. once a specific decision is made. And we'll just say, therefore, out-of-pocket costs are very irrelevant to a specific decision. Yeah, there's no reason there's nothing different about them where they wouldn't be included in the accounting records or something like that. That just, it is the cost that we will incur by pursuing that specific option. And when we get to that point, they will definitely be accounted for. Cool. Okay, let's answer the last problem here. What is an opportunity cost? And are opportunity costs included in the accounting records? So we already kind of talked about this above, but opportunity costs are the potential financial benefits lost by taking a specific action when two or more alternative choices are available, right? So like we talked above, if you're going to college, that takes time, so you have less time to pursue different employment opportunities. So therefore, going to college has an opportunity cost where you could have earned more money if you weren't going to college and you were instead spending that time doing something that earned profit, basically, right? Unlike out-of-pocket costs, which are incurred expenses recorded in the accounting records, opportunity costs are just conceptual and not recorded in accounting records. So they're still relevant, but you only record costs, when you incur them specifically, and if you're not actually, it's not a real cost in that way, like it would be to pay to go to college, right? Versus income that you potentially lost, because you don't exactly know what that is. It's more of an estimate, kind of an idea. And again, it's more kind of theoretical and conceptual, but still important and relevant and real. If you do go to college, there's definitely less time in your day, in your week and day to work and make money. So it's not that they don't exist, in the real world and aren't important. It's just that they're not something that would be recorded in accounting records specifically. Okay, let's move on to quick study. And in quick study, we've got a couple problems here. Let's clean up the chaos just a little bit and focus on number one. Okay, so let's one thing I really like to do, just in general, and just especially for this chapter and these problems, is really lay out the factors, right? Well, that looks weird. So it's a product. Okay, let me unwrap this text actually. Units of product produced last year. So the first thing we'll say 10,000 units. So like I said, I just like to put these all in kind of a format here where they're easy to analyze. So 10,000 units of product that were produced last year at total cost of production. See, you're all wrapped text. Let me take that off because that makes it go funny. Cost of units produced last year. Is it still wrapped, the text? I thought I turned that off. Undo, man. It's not one to undo it. Funky. 150,000. I have a feeling these might be irrelevant. Again, this might be a sunk cost kind of a thing. But let's keep just put them in here. It doesn't hurt, and it's easier to analyze, I think, when it's kind of just all laid out. Okay, so that was 150,000. The units were damaged in a rainstorm because the warehouse where they were stored developed a leak. So Marathon can sell them. Okay, so selling price as is. Selling price will say per unit. And that is $3 each. Or repair cost in total, so not per unit or anything. I'm just going to paste this in so it's got the same format, and then we can say repaired sales price per unit, and that was $5 each. So take that, update it. Okay, so should we sell the units as is or repair them and then sell them? So those are our two kind of pathways here. So let's kind of like just making sure we lay this whole logic out. It's not too complex necessarily, but got kind of a, let me copy and paste in an example sort of the, let me get this so it looks decent. I'm just taking an example that we had from the in-class problem. So we could say one pathway is sell as is, and then this one is rework, or in our instance, repair and then sell. Okay, so two pathways. Again, not crazy amount of detail to analyze, but I just like to get this laid out. It helps me sort of think about it. And sometimes think about spreadsheets as art or something. Just make them look good. It helps me think about things when they look nice and it's easily organized, etc. I don't know, maybe I'm weird, but that's just me. Okay, so if we're going to sell them as is, there's 10,000 units, right? And we're going to sell them for $3 a piece. And so we're going to earn $30,000 for these damaged products, right? There's no additional costs. We're not incurring anything else. We're just getting rid of them. It's easy. It's guaranteed. We're selling them. Now, if we repair them, we're going to, again, sell 10,000 units at $5 per unit once they are repaired. But the repair cost that we have to incur here is $16,000. And so you can see if we take alternative route to repair and sell them, we're going to profit by $4,000 more. So generally speaking, from a purely financial perspective, this option is more profitable, but oh gosh, that's so funky. It does not want to let me undo it that way. Let me get it. But okay, so this option is more profitable, just based on this kind of quick math, right? But what we have to watch out for is this is based on assumptions. This is a known thing, right? There's that old saying. What is it saying? Two in the hand is worth one in the hand is worth two in the bush, right? So if we know we can get 30,000, guaranteed, like we know this is true. Oh, didn't even move that. We know this is true. This is a guarantee. This is not guaranteed. We still have to sell these products. It's not, maybe if it's a guaranteed sale and we have someone who will say, hey, we'll buy them, if there is some guarantee related to this, then awesome. But that's the kind of thinking you want to have in your mind, is that there's an employee morale component, to doing the rework and repairing maybe, and that could be detrimental to the business in certain ways. And then this is are we sure this is a repair cost? Could the cost go higher? And then are we sure that we can sell all these at this price once they're done? Those are unknowns potentially that we might want to be a little careful on. And if the profit margin between choosing this pathway versus getting a guaranteed return, if it was me, that would be a hard decision, because if you guaranteed thing, move on with your life, fix the leak, the headache of not having to deal with repairing and selling might not be worth $4,000. So, this is a great chapter for just getting us thinking, but then there's those real world considerations that we have to kind of take into account. So I like these problems. Okay. Let's move on to 2. Okay. And, so we have this company has been approached, a new customer, to provide 2,000 units of regular product, special price, $6 per unit. Regular price is $8 per unit. Helix is operating at 75% of its capacity, 10,000 units of 10,000 units. Identify whether the following costs are relevant to their decision. So we were operating at capacity of 70. So 7,500 units, I guess, we're producing, I think is what we're saying. I think that's what we're saying. Anyway, okay, we'll come back to that if that's important. Identify whether following costs are relevant to our decision. No additional fixed manufacturing overhead will be incurred. The only additional selling expense will be 45 cents per unit shipping cost. No additional admin expenses. Place an X to identify what's relevant or not. So selling price of $6 per unit, definitely relevant. That's something we need to think about when we're considering. Direct materials, direct labor, those are all variable costs directly associated with the production. Variable costs, variable manufacturing overhead of $1.50. That will, again, it's variable. It goes up with production. So those are all relevant. It says no additional fixed overhead will be incurred. So the fixed overhead is not relevant to this consideration. It also says there'll be no additional selling expenses of the regular selling expenses. Additional selling expenses of, that's funny, it says 50 cents per unit, but here it says 45. Oh, no, it's shipping, sorry. Where does it say that? I think that's supposed to be this one, unit shipping cost. That's weird. So I'm going to just change this to be 45 cents to match what it tells us above. So that is important. Administrative expenses says we don't incur any additional, so there's nothing, it's not incremental, it's not related to that product. And then regular selling price of $8 per unit, again, from a financial perspective, it's not relevant, but again, the non-financial consideration of making your customers, current customers who pay $8 a unit angry potentially, from a non-financial perspective, maybe that should be considered. But okay. So I'm going to do a similar thing. I'm going to give us some space here and then pull in I have this template from our in-class problems that I think is handy. And this is an additional, accept additional business type of problem here. We don't have space. Oh, geez. Okay. Let me unwrap. It does not want to let me unmerge or unwrap these. So weird. Let me do Format Painter, because that seems to be working. Get rid of a bunch of the formatting that this does not like. I'd like to use my template. Okay, there we go. Perfect. Okay, so let's fill this thing out. So additional sales units is 2,000. Sales revenue per unit is $6. Just pulling all this in. The regular selling price, right? We ignore that. Helix is operating at 75%. So yeah, I think we can sort of ignore that for the time being. I think what, in terms of thinking about that, if we're saying capacity is 10,000 units in total, and we're operating at 75% of our capacity, we have an extra 2,500 of capacity left. So it doesn't sound like the production of 2,000 units would exceed 2,500 capacity. So we should be okay. And that shouldn't affect current sales, I think, is kind of the point there. Okay, so what else is important? Increase to overhead, there's none, but selling expense increase. This will be per unit. Give a little more space there, and that will be 0.45 of shipping expenses. Okay, so this just lays out kind of the important details. There's no increase to overhead, so I'm just going to delete that out because that's not really needed. Cool. Now, let's do a little. So this one's a little different. The problem I pulled in from the homework was more based on using a current sales forecast to determine cost per unit. So let's delete that portion out and let's just analyze the additional work piece here. And we're going to say 2,000 units. The sales will be $6 times 2,000 units. And let's put some additional information in here, though. I'm going to copy all three of these, paste these in here. And we've got direct materials per unit, direct labor per unit, and variable overhead per, I'm just doing the slashes per unit here, and that will be $1 materials, $2 labor, and $1.50 of, let's have that same formatting of variable overhead. And then I think it said fixed manufacturing, it doesn't matter, you have no additional fixed manufacturing, and then just the additional 45 cents of sales cost there. Okay, so sometimes we need to adapt our templates to the problem, but I like always having something to start with. Makes it a little cleaner. Okay, direct labor then is going to be 2,000 units times direct labor per unit, or $2. Direct materials will be $1 per unit. Pretty easy math, 2,000. No additional overhead, so we're going to delete that column. No additional admin expenses, and then delete that column too. And then the additional selling expenses is just 45 cents times 2,000. So per my calculations here, it looks like we've got 5,100. But it says additional items 12. What are we missing? Okay, we're missing something. Oh, wait, did I? Oh, I'm missing variable overhead. Oopsie. So that one other piece there, 2,000 units times variable overhead. Can't forget that one. So that gives us 9,900, and then we end up with 2,100, which is what our hint tells us the income from the additional units should be. So now that's helpful to make sure we've got everything included. And yeah, it looks good. It makes makes additional revenue. We're earning money on the work, and as long as it doesn't impede with anything that we're doing, and it doesn't sound like it, sounds like we have the capacity, then we should be basically good to go from a purely financial perspective, right? But here it says, refer to quick study problems. What non-financial factors should we consider? And the most important non-financial consideration would be the impact on other customers of the company. We'll say once word gets out that a special price was given, other customers could demand that price as well, or potentially leave, or take their business elsewhere. How about that? Take their business elsewhere. Let's see. Plus, if the new customer, let's see. Sorry, I just had a little glitch in my video there, but I think it's working now. Okay. So yeah, we got to worry about our other customers' price, knowing the special price was given possibly. Plus, if the new customer continues to stay with the company over the long term, it would take up capacity that might be used by full price paying customers. So it's important to specifically delineate or, tell the customer, this is a special price. And if you, spell check real quick. If you stay with us, then, that's kind of a problem, right? Because we could be earning more money. So you got to be a little careful on taking these jobs for those reasons. And, that's where all the other parts of the real world type business stuff comes into play. Contract negotiations and, managing the risks of other customers finding out, etc. All very important things to consider. Okay, let's move on to the exercise tab. And in the exercise tab, we have a problem where we can produce 2 specialized products. And let's give ourselves space here. I don't want to see that second problem until I need to deal with it. Okay, got a check figure. And we got selling price per unit and variable cost per unit. So Jersey Company owns a machine. Production time is 2 hours per unit for this one. And TLX and MTV is 4 hours per unit. So we've got different variable, this tells us direct labor. And yes, okay, we have a capacity of 14,500. Both products are sold to a single customer who can buy all of the company's output up to a maximum of totals. We have limited demand here of these totals. Selling price and variable cost per unit is shown below. Determine the most profitable sales mix and the contribution margin that results from that sales mix. Okay. So let's take a look here. I think I'm going to trying to think if I could, I can't really take those ones. Shoot. Okay. There's some handy problems that we did, that are kind of nice to look at in a way, that I think give us some decent template. So I'm just going to snip these, not copy them in as Excel things specifically, but I think having these side by side can help us sort of set up our analysis in a way. Okay, and we might need to do a little extra work, but I think that's a good starting point. Okay, so let's put sales price, and actually first let's do columns here. So this is TLX and this is the MTV. So we've got 2 different products like we were talking about. And just put a little borders. Okay. So the sales price per unit, and we're just going to do our contribution margin first, just like we kind of have listed out here. And we've got variable cost per unit. Oh, that's too far. Let's see. And this tells us above variable cost per unit for TLX. And so then our contribution margin, and I'm just going to put CM per unit, is $865 for TLX and $1176 for MTV. And then we have machine hours per unit more space. It just tells us this above. It was 2 per unit for TLX and 4 per unit for the MTV product. And I'm going to make this currency just because we're mixing things up in our table so we can delineate those. And then we can say contribution margin per machine hour. Boom, boom, boom. So let's do a little easy math here. So we just take contribution margin per hour. Drag that over, and I'm going to format paint. Oh, geez. Wrong one. Okay, so $4.33 per machine hour and $2.94 per the MTV. Okay, so now we've kind of got this whole breakout. So let's now follow down here kind of what it says. So I'm going to take this again and create a separate table down here that's going to say CM per machine hour. So 433, 294, and then let's say machine hours to meet demand. And so if we have, let's look at our things. So buy up all to a max. So a maximum demand would be 33,740 units of TLX. So 3740 units times 2 hours is 7,480 hours to meet the demand. And then it's 2,090 units for the MTV product. So 2090 times 4 hours per unit. So that's the number of units times the hours. Gives us our total number of hours that we would need. And so if we can maximize the higher demand, product, essentially, we're going to want to do TLX first, right? So then we can say most profitable sales mix in units, just kind of following this template, how it's sort of laid out there. I think it's good. And hopefully you can kind of make the connections between these sort of products, problems that we're doing. Okay, so let's, what is our total machine hours? So we have 14,500 machine hours. So we're going to want to do the full amount of the mix here, and that is 3740 for this one. And that means in units, I'm going to say in hours, I think this is helpful to kind of see, because then we can say, okay, and maybe that's clear because we did it up here, but that's fine. This will be a little different for MTV, I think. So we're producing full demand. It's going to take us that many hours. Our total available hours is 14,500. So here we can say 14,000. So all the hours that we have left is 7020, right? Because adding those together gets us our maximum hours, max hours possible. And so now the final thing we need to figure out for our units then is to say, if we have this many hours, how many units does that produce? We can divide that by 4. So it's 1,755. And we can look to see, are we meeting demand? No, they buy 2090, but we can only produce 1755. So that's, we can't meet their demand on the MTV, but they want TLX too. So let's maximize that to begin with. And okay, perfect. And then so the contribution margin that results from these products. Okay, so here's a little bit of an extra wrinkle, I guess, in terms of kind of doing this. So let's do basically what we're going to be calculating now additionally is more like totals, variable cost total, and then contribution margin total. Okay, so we're selling this many units, right? Let me find it. Where are we? In units, 3740 times the sales price of, or sorry, contribution margin. All right, we could, yeah, let's just do, oh yeah, I guess we just really need contribution margin because we know what it is per unit. So, derp. Bear with me here. So I think we can just do contribution margin total, basically, right? So we know the contribution margin per unit is 865. Multiply that by the number of units that we're going to be selling. So the TLX is going to be 32,351, and the MTV is going to be 20,639. I guess there's a little change on there. So yeah, if we add those together, total contribution margin then becomes $52,989.80 at the max, most profitable sales mix. So not anything super crazy, hopefully, in terms of logic and analysis, etc. But it does, I think, having some framework is important because you can really it's easy math when it comes to the actual calculations, I think, but it is overwhelming maybe if you don't know how to start the problem or how to sort of formalize your thinking, organize your thinking, etc. So hopefully that helps, and this video helps and all that. So there we go. And even just using, resources like this, looking at an example from another place and pulling that in, I find that very helpful for myself. Okie dokie, let's move on to number 2. So Marinette Company makes several products, including canoes. We've been experiencing losses from a canoe segment, considering dropping that product line. And the following information is available should we can discontinue the manufacturing of the canoes. Support your decision or not. Okay, so this is like a keep or eliminate type of decision. What do we call that? I think a segment elimination problem, basically. And so it just tells us the incomes, we've got our income statement just for the portion of the problem related to the canoes. And we've got variable cost, contribution margin, and then we've got fixed costs, total fixed costs, and net income, right? And so it looks like, we are losing money, and we are on those segment, but we have some indirect costs that we need to factor in. And so one way to do this problem, which I think is probably the easiest way, I'm just going to copy this, paste this same thing here next to it. I think this is a way we can do this. Let's try it. And here, this is going to be our keep segment part. And this over here is going to be our eliminate segment analysis. I think it just, we can sort of just straight up use that as our analysis tool or whatever, if you want to think of it that way, because it's all got formulas and everything else. We can just eliminate stuff that's going to be eliminated if we don't have to keep the segment, basically. Whoops. All right, I'm just being picky because there's a little bold line at the bottom that I was trying to get the same, but I think I can do it. Why is my little line at the bottom not working? Boom, there we go. Now we got our nice little bold line there. Very similar, same information, basically, as of now, they're exactly the same. So if we keep the segment, we know we're going to lose 125,000. But let's think about eliminating it, right? So if we eliminate it, there's no more revenue, but there's also no more materials. There's no more variable costs, right? There's no more direct variable costs. And then it just really comes down to the cost, the fixed costs, right? And so the allocated indirect costs, those are going to stay, but the direct costs are going to go, right? And so really what you end up seeing is you have these indirect costs, which are being absorbed by this segment. And so while it looks, and it is, we're losing 125,000 by having the segment in place. If we were to get rid of it, we can't get rid of these $300 in indirect costs, and those will be incurred elsewhere. I mean, it's possible maybe that we get in there and figure out how to axe some of these costs that are indirectly allocated. But for purposes of the here and now and today and what we see as a better strategy or pathway, because we're incurring these indirect costs and the canoe segment is effectively absorbing a decent portion of those, then we're probably better off looking to see whether we could just make this segment more profitable, and so on and so forth, right? So the difference between these two basically is 175,000. So we would lose more money by eliminating the segment because we can't get rid of these costs than we would by keeping it, so on and so forth. So let's just say conclusion: keeping the segment, or let's say it the other way: eliminating the segment will cost an additional 175,000 in unavoidable costs. Thus, we should keep the segment. And you could put in other information like we should try and figure out how to make it profitable, or maybe I'll put that in. We should keep the segment and look for ways to increase profitability of the segment, or potentially look for ways to reduce the indirect. Let's just leave it at that. Let's look for ways to let's not be too negative. Let's be positive here. We're gonna figure this thing out. Okay, very cool. So sometimes you can use what they provide you as a, this versus this kind of template in that way. So that's kind of nice. All right, let's move on to our last problem here, the PR tab. Let's take our grid lines out. We have this company manufactures and sells to local wholesalers approximately 150,000 units per month at a $4.50 sales price per unit. And so with all that said, this is our total costs, etc. Okay, so here's some hints and stuff. What is that? Units. I guess this is like something we could use to calculate, but yeah, we'll see if we need that. Okay, so a new out-of-state distributor is offered to buy 25,000 units for $344, marketed in other states, not affect wins sales through normal channels. And a study of the cost of this new business reveals the following. Direct material cost, 100% variable. That's kind of goes without saying. Per unit, direct labor cost for the additional units will be 50% higher than normal. Okay, so we have overtime. So that's good to know. Sometimes it becomes more expensive and it's not just directly one for one in terms of variable costs. 25% of the normal annual overhead costs are fixed at any production level from 125 to 200,000. So the remaining 75% is variable with volume. So 25 and 75, 25 fixed, 75 variable, and no additional selling expenses, and admin expenses go up by $2,000. Okay. So it tells us to prepare a 3-column comparative income statement that shows the following: monthly operating income without the special order, monthly operating income received from the new special order business only, and then combined. Okay, so we can do that, and let's see. So I'm just trying to think if I can use any of our templates that we have already. Let's try and use this one and see if we can get it to work. And sometimes we got to do a little adjusting and whatnot. But yeah, let's take a look. Okay, so currently, approximately 150,000 units per month. So 150,000 units. And actually, I'm going to put our additional data in here. Copy and paste this over. That fits better. Okay. So let's put so it would be an additional 25,000 units per month. The sales revenue would be 344. Oh geez, that's not what I meant to do this. Okay, 344. Direct material cost, yada yada yada. Okay, so we can kind of just fill this thing out. So that's total costs and expenses, $450 per unit. Let's go ahead and say, so this will be additional. Let's copy this. I just like putting my variables in Excel just so we can kind of link to them. And let's call this current. And this would be, I think it said $4.50. Okay. So let's figure out what our current sales forecast is. So we have, let's do current sales in units. I think it was 150,000. I guess we've already got that kind of here, but Okay, so then we have 150,000 times 450. And that gives us, what, 675,000 in income. Okay, and then direct labor. I almost want to snip this just so I can see it. Here, let's do this. I'm going to hide these columns just to kind of make everything visible on one screen real quick. And then we'll say direct labor, 48. Direct materials is 201. Overhead, 144,000. Selling expenses, 60,000. And admin expenses of 40,000. So that gets us net income of 182,000. Okay. Now I'm going to unhide. So you just do the kind of like highlight around the rows that are hidden, and then right click and click unhide. That's just an easy way to sort of analyze there. Okay. So what else do we need to see? Let's put some more factors in just because I like putting factors. Direct material, 100%. Labor, so direct labor increase, or direct labor, let's say increase would be 50%. I will say per hour. That's good. And then let's say selling, no additional selling expenses, but we do have additional admin expenses of 2,000. And what else? Okay, let's say overhead costs. So variable overhead percentage is 75%, and then fixed overhead percentage is 25%. Okay, so I think that's everything we could think of. So that's kind of our column one. They told us to do 3 columns here, so let's just paste those in. So current sales forecast, additional sales, let's say forecast, and then we'll say combined sales forecast. Okay. Cool. So our additional units is 25,000. The sales we're going to get from that is 344 per unit. 86,000. Direct labor now is going to be 25,000. Oh, you know what? Here's a little helpful thing. Let's do how should we do this? I'll just keep on making columns here. I think this is handy. I don't know. It's good just data to have here. So let's say, and that's kind of what they were trying to get at over here. And you know, actually, I like doing, let's undo that. I'm going to undo. In class, I kind of had a breakout of these things with the variable costs essentially sort of broken out. So I think that was kind of a nice way to present it. I'm just going to clean this up a little bit. Make this column a little smaller. Okay, and then let's just say per unit. That's kind of a handy way to do it. So just I like to have the sales just because I find it, wait, we already have it, don't we? No, we already have it, but whatever. I find it useful to sort of just have there. So direct labor per unit is 32 cents, it looks like, per unit. Okay. Remember, we're going to have to multiply that by 1.5 because we're paying 50% more. Direct materials, I'm just going to drag the formula down and then fix it. And then overhead, selling expenses, that'll be no additional. Admin expenses is just the 2,000 increase there. So we can just put the 2,000. And so we don't really need these columns or these boxes. Let's get rid of those. Clean up our table. Okay, the overhead's a little tricky because the per unit one is, we're saying it's 75%. So 75% of the 144 is variable. The other part is kind of irrelevant because it's fixed. So if we want to separate this out, let's do it in a separate spot just because it's kind of a two-part deal. That's a little hard to do there. But let's say overhead total, and then we'll say fixed percent, or we'll just say fixed portion. We've got percentages above, variable portion. And one thing I like to do, we did in a previous chapter, was just kind of have this breakout to compare the totals, make sure we do our math right. So 144, we take the fixed portion would be the 25%, I believe, yep. And then the variable portion is the 75% times 144. Now what I like to do there, is just add them. So again, we can see that our maths check figure for us, easy to see. Yep, 144, we've allocated correctly. And so then the per unit of the variable becomes, divide that by the 150,000, and that becomes 72 cents, it looks like. So that's the variable piece. This piece doesn't matter, that's just fixed. It doesn't do anything for us really. So if we want to have a similar format, that's the piece that's going to matter for the additional sales. Okay. Okay, we're almost there. Now we just need to figure out our total costs here. So again, we're going to say 25,000 units times the normal direct labor cost times, and we'll say 1 plus 50%. So that'll basically make it times 1.5. That's another way to think of it. We can just do times 1.5. Maybe that makes more sense. Times 1.5 times time and a half, right? Because they're working overtime. They told us in the problem above. So we end up with 12,000 of direct labor. Direct materials is just variable based on the units. And what else? Okay, and then our overhead become, again, we're just taking the variable portion times the units, so it's 18,000, and we have the selling cost. So total net income from the extra work is 20,500. So that's good. I mean, step one, it kind of shows us that we're making a profit on this thing, and that is a good thing. Oh, and I guess our check figures tie out too. Like we 182 and 20,500, so we're on the right path. And then we can just kind of do we don't need this as a box, so just to be extra formatted. How's that look? Let's get rid of our little guy there. So cool. If we really want to be fancy, we'd say C below, because that would be the breakout of the fixed versus overhead. So cool. Awesome. So then let's just add everything together. Drag it down. And 202,000 versus 182. So, it's worth it to take the extra work. Here's our updated whole deal. Maybe we should worry about offering the lower rate, but it does tell us in this instance that they are different channels in different states and yada, yada, yada. So it wouldn't impact us, as far as the current customers go. And yeah, that's pretty cool. So hopefully that all makes sense, and hopefully you all appreciate sort of the, I don't know, like I do, just making your analysis and your table really look clean, I think is important. And in the real world, if you're doing some reports and analysis and having a nice spreadsheet, I just think having it a little more like clean and presentable and nice to the eye and easy to review is really nice for, managers, and people above you will appreciate that, because it's easy to see, and it also makes it easier to work with as you go back through if you have to change, things, or if you want to carry it from month to month, etc. Just make it less chaotic and disorganized if you can. And here so in that vein, we'll say overhead allocated, or we'll say fixed versus variable overhead allocation. And then we'll say variable overhead per unit. So it's kind of like how I think of this. If you remember, actually I'll put that over here. If you remember from accounting 2, how we would put explanations in for our journal entries, which is a good practice. I think it's also a good practice to create, nice spreadsheets that are clearly identifiable. They're easy to go back to and see what you're doing. All your variables are clear. So I think that's just as important, if not more important, than having good journal entry practices and organization and all that kind of stuff. Just having good spreadsheet skills to make things clean and understandable, and give you if you go back to look at it at a later point, what you did made sense and it was easy to analyze. So good practices. Hopefully you guys pick up on some of that and carry it forward with you into the working world. Your managers and reviewers of your work products will appreciate it, and they will think you're a good employee, and you'll get promoted, and you'll be super rich, and it will be awesome. All right. You'll be raking in the dough just like this company. Well, thanks, everybody. Hopefully you found the video helpful. I appreciate you watching, and I will talk to you all soon. All right.